There's no crash in the headlines, no panic in the markets, yet U.S. household debt has just hit a record, over $18.5 trillion, not during a recession, but during a so-called soft landing. Debt doesn't rise when an economy is strong. It rises when income can no longer keep up with costs. And as job cuts quietly accelerate, those two forces are beginning to converge. In an economy where nearly 70% of GDP depends on household spending, that combination matters. This video explains why record household debt is appearing at the most fragile moment of the cycle and what it says about the real condition of the American consumer. To understand why this matters, we have to step back from the headlines and look at how household debt actually built up and why this cycle is fundamentally different from the ones before it. A record that arrived at the wrong moment. U.S. household debt has reached a level never seen before. According to the Federal Reserve Bank of New York, total household debt climbed to $18.59 trillion in the third quarter of 2025, rising by $197 billion in just 3 months. On its own, a new record does not automatically signal danger. Debt tends to grow as economies expand. What makes this moment different is the economic context in which this record is being set. This increase is not occurring during a period of strong income growth or broad-based financial resilience. It is happening as inflation has permanently reset core living costs higher. Savings buffers have been depleted, and households are increasingly relying on credit to maintain spending. To understand the risk, the structure of the debt matters. The largest share remains mortgage debt, which now stands at $13.07 trillion, accounting for the majority of household liabilities. This segment appears stable at the aggregate level, largely because most existing homeowners hold long-term fixed-rate mortgages originated before interest rates rose. However, that stability masks a growing divide. New buyers face higher prices and higher borrowing costs simultaneously, pushing affordability to historic lows. Mortgage debt is no longer expanding from household formation alone. It is expanding alongside rising financial strain. The more telling pressure is concentrated outside housing. Credit card debt has climbed to a record $1.23 trillion, increasing by $24 billion in a single quarter. With average interest rates near 20% or higher, this category reflects borrowing for everyday expenses rather than discretionary consumption. At these rates, revolving credit becomes less a temporary bridge and more a permanent burden on future cash flow. Auto loan balances now exceed $1.66 trillion, with loan terms continuing to extend. Longer maturities reduce monthly payments, but increase total cost and lock households into depreciating assets for years. This structure reduces flexibility, precisely when household budgets are under pressure. Student loan debt remains elevated at approximately $1.65 trillion. Delinquency rates in this category are among the highest in the system, particularly for younger and lower-income borrowers. For these households, debt absorbs income before it ever reaches consumption. Taken together, these categories reveal a critical pattern. Household debt is rising faster than income for lower-income and younger households, even as aggregate balance sheets appear supported by housing wealth. According to multiple U.S. media reports citing Federal Reserve data, delinquency rates are climbing most rapidly in precisely these vulnerable groups. The overall delinquency rate across household debt has risen to approximately 4.5%, the highest level in recent years. Student loan delinquencies approach 10%, signaling growing stress beneath the surface. This matters because debt does not exist in isolation. It depends on income stability and financial buffers. Yet the same period that produced record debt has also seen savings rates fall back toward historically low levels, leaving households with less capacity to absorb shocks. In this environment, debt is no longer expanding as a tool for growth. It is expanding as a tool for substitution, replacing income that no longer covers rising living costs. That distinction changes the risk profile entirely. When borrowing replaces income, the system becomes sensitive to even minor disruptions. Spending can appear resilient while underlying financial capacity erodes. The economy continues to function until it doesn't. And that is why the timing of this record matters more than the record itself. When income starts to weaken, household debt only becomes dangerous when income starts to weaken. That shift is now beginning to appear. In October, U.S. employers announced more than 153,000 job cuts, according to Challenger, Gray, and Christmas, a 183% increase from the previous month and the highest October total in over 22 years. Announced layoffs for the year have now exceeded 1 million. These figures do not signal a labor market collapse. Challenger data captures only layoffs, not hiring, and should be viewed as a directional indicator rather than a definitive measure. But direction matters. The direction is clear. Companies are shifting from expansion to cost control. Much of this adjustment reflects overhiring during the pandemic and efficiency gains from automation and artificial intelligence. Still, the impact is the same. Job cuts remove income from the system. Even more importantly, labor market weakness rarely begins with mass unemployment. It begins quietly. Reduced overtime, shorter shifts, hiring freezes, fewer bonuses, contract work that does not renew. These changes do not raise unemployment rates, but they immediately reduce household cash flow, particularly for lower and middle-income households already under pressure. This erosion of income is occurring at the same time households are carrying record levels of debt. Debt can be managed when income is stable. It becomes fragile when income turns uncertain. Fixed payments do not adjust when hours are cut or bonuses disappear. Flexibility vanishes quickly. The structure of the U.S. economy amplifies this risk. Nearly 70% of GDP depends on household consumption, which is driven by wages and hours worked, not asset prices. When income weakens, spending does not collapse immediately. It erodes gradually. This creates an illusion of stability. Nominal spending can remain elevated even as purchasing power declines. Consumers spend more dollars but buy fewer goods. Businesses feel this shift through softer demand and rising inventories, and they respond by cutting costs, often labor costs. The result is a labor market that appears stable on the surface but grows increasingly fragile underneath. This matters because the current debt cycle is not supported by rising incomes, it is supported by borrowing. As long as income holds, the system functions. As income weakens, debt becomes a constraint. October's layoff data does not predict a crash, it signals a transition, one that raises the stakes of record household debt. Why consumer spending still looks resilient. Even as household debt rises and income pressure builds, consumer spending still appears surprisingly resilient. That resilience is real, but it is also misleading. Nearly 70% of U.S. GDP is driven by household consumption, and in aggregate, spending levels remain elevated. Retail sales continue. Services activity holds. Headline data suggests the consumer is still functioning, but the composition of that spending has changed. Nominal spending totals reflect higher prices, not higher purchasing power. When inflation raises the cost of essentials, households spend more dollars simply to buy the same or fewer goods. Revenue can rise while real demand weakens. This distinction matters. Businesses do not respond to dollar totals, they respond to unit volume. And across many sectors, unit growth has slowed or turned negative, even as revenues remain stable. Consumers are spending more but buying less. This creates a false sense of durability. Spending does not fall all at once, it erodes quietly. Households cut back at the margins, fewer discretionary purchases, delayed replacements, smaller baskets. Essentials are paid first, choice is reduced. At the same time, credit fills the gap. When income no longer fully supports spending, households turn to credit cards, longer auto loans, and deferred payments to smooth consumption. This keeps spending visible in the data while shifting the cost into the future. The economy appears busy, but it is increasingly hollow. This phase often precedes broader slowdowns. Nominal spending can peak just before conditions deteriorate because inflation lifts totals even as financial capacity shrinks. By the time spending visibly declines, household balance sheets are already strained. The danger is timing. Policymakers and markets tend to focus on headline consumption numbers. As long as spending holds, financial conditions remain tight, and policy support is delayed. But beneath the surface, spending is becoming less voluntary and more compulsory. Households are not expanding demand, they are maintaining it. And maintenance depends on credit, stable income, and uninterrupted cash flow. When any of those weaken, spending does not adjust smoothly, it breaks. This is why consumer strength often looks strongest just before it fades. The economy continues to function until the mechanisms supporting it begin to fail. Which leads to the next question. What happens when credit, the last support holding spending up, begins to tighten? When credit stops absorbing the shock. For a time, credit can mask stress in the real economy. It absorbs the shock when income falls short. But credit does not eliminate pressure. It concentrates it. As household spending shifted from income-driven to debt-driven, the system became increasingly dependent on continuous access to credit. Credit cards, auto loans, personal loans, and buy now, pay later programs filled the gap between wages and rising costs. That only works while lenders remain willing and borrowers remain liquid. The problem is that credit is now expanding faster than household income, especially at the lower end of the income spectrum. Credit card balances have reached record levels, and interest rates on revolving credit now sit near 20% or higher. At those rates, credit stops functioning as a bridge. It becomes a drag. Minimum payments rise. Interest compounds. Future cash flow is pulled forward to service past spending. Each dollar borrowed today removes more than $1 of spending capacity tomorrow. This is where stability becomes fragile. Once debt service absorbs a larger share of monthly income, households lose flexibility. Any disruption, higher prices, reduced hours, unexpected expenses, immediately creates stress. There is no buffer left. And the early signals are already visible.
Delinquency rates are rising across credit cards and subprime auto loans. These are not isolated events. They are pressure fractures forming where households are weakest. Defaults appear first at the margins, then spread as conditions tighten. Lenders respond mechanically. As delinquencies rise, underwriting standards tighten. Credit limits are reduced. Promotional financing disappears. Access becomes more selective. The very tools propping up consumption begin to retract. This is the inflection point. Credit that once stabilized spending now amplifies downturns. As borrowing slows, consumption loses its artificial support. Spending does not decline because confidence collapses. It declines because credit availability does. This shift often happens faster than expected. Credit markets reprice risk in steps, not gradually. Once lenders reassess household durability, adjustments happen all at once. That sudden tightening removes liquidity from households precisely when they need it most. And unlike financial markets, households cannot roll losses forward. When credit tightens, spending contracts. When spending contracts, revenues soften. And when revenues soften, the pressure moves upstream toward businesses and employment. Which brings us to the final transmission mechanism. What happens when weakening consumers meet a labor market that is quietly thinning?
A labor market that weakens without breaking. When consumer spending softens, the pressure does not hit employment immediately. It moves quietly through margins and hours, not headlines. This is why labor markets often appear resilient right up until they are not. Recent layoff data points to a shift in that direction. October recorded the highest job cuts for that month in over 2 decades, with more than 150,000 announced layoffs. Employers have now announced over 1 million job cuts this year. On its own, that does not signal collapse. Companies are not panicking, they're adjusting. Instead of mass layoffs, firms reduce overtime, cut shifts, freeze hiring, eliminate contractors, and quietly allow positions to go unfilled. These changes rarely show up in unemployment statistics, but they reduce household income immediately. This is how income weakens without triggering alarms. Payroll numbers can remain positive while real earning power deteriorates. A reduction of just 2 to 3 paid hours per worker per week, spread across millions of workers, removes tens of billions of dollars annually from consumer spending capacity. Wage growth does not offset this erosion. Nominal raises fail to keep pace with higher insurance premiums, rent, utilities, and debt service. Workers remain employed, but their discretionary income shrinks. This creates a dangerous disconnect. Official labor data measures job counts, not job quality. It does not capture lost hours, reduced benefits, or income volatility. As a result, the labor market can appear healthy, even as households feel increasingly constrained. Corporate behavior reinforces this trend. As revenues flatten and margins compress, labor becomes the fastest adjustable cost. Companies preserve earnings by shifting pressure downward onto workers' time, pay variability, and security. This process is mechanical, not emotional. Firms respond to weaker demand by protecting cash flow. But in doing so, they weaken the very income stream that supports future consumption. The adjustment stabilizes balance sheets in the short term while undermining demand over time. This is where the loop tightens. Households facing reduced income lean more heavily on credit. As credit tightens, spending pulls back further. Businesses see weaker volumes and respond with more cost controls. Each step reinforces the next. The labor market does not collapse suddenly. It thins, and thinning is enough. Because in an economy where consumption drives nearly 70% of GDP, even small, widespread income reductions can have outsized effects. The system does not require mass unemployment to destabilize. It only requires millions of households earning slightly less at the same time. This is the condition forming now. The labor market still functions, jobs still exist, but the income supporting consumption is weakening beneath the surface. And when that erosion reaches scale, the final question becomes unavoidable. What happens when households, credit, and income all tighten at once? When the system turns on itself. Economic downturns rarely announce themselves with chaos. They begin quietly, through feedback loops that tighten one constraint at a time. By the time stress becomes visible in headlines, the mechanism driving it has already been operating beneath the surface for months. What ultimately matters is not any single variable, not household debt, not layoffs, not inflation, but how these forces interact and reinforce one another. This is the moment when the system stops absorbing pressure and starts amplifying it. Households experience rising fixed costs while income growth slows or reverses. To maintain basic consumption, they lean more heavily on credit. At first, this masks stress. Spending continues. Economic activity appears stable. But higher balances bring higher minimum payments. Delinquencies begin at the margin among younger and lower-income borrowers, and then spread. Lenders respond not with panic, but with policy, tighter underwriting, higher standards, less tolerance for risk. Credit becomes selective. Once access to credit narrows, consumption loses its last buffer. Households are no longer smoothing spending over time. They are forced to cut. Discretionary categories weaken first. Essentials follow later. Businesses feel this shift quickly. Revenue slows before costs adjust. Companies respond the only way they can: hiring freezes, reduced hours, layoffs. That further weakens income across the system, feeding back into household stress. The loop closes and then accelerates. What makes this phase dangerous is that it does not look dramatic. There is no single collapse. Transactions still occur, jobs still exist, the economy remains technically functional. But behavior has changed. Households are no longer optimizing, they are defending. Firms are no longer expanding, they are preserving. Lenders are no longer competing, they are screening. This is not a confidence shock, it is a balance sheet adjustment. Financial markets often misread this stage. Asset prices can remain elevated because liquidity has not yet been withdrawn. Earnings may appear resilient due to cost-cutting, buybacks, or accounting effects. Equity markets react to margins, not demand quality. That creates a dangerous divergence between markets and the real economy. Revenue weakness does not immediately trigger market stress, but it compounds. Promotions deepen, profitability erodes, defaults rise, credit losses expand, banks tighten further, liquidity slowly retreats. By the time markets react, the real economy has already moved. Policy response typically follows, but policy operates with delay. Lower interest rates can stabilize asset prices quickly. Liquidity injections can calm financial conditions, but they do not immediately restore household balance sheets. They do not rebuild depleted savings. They do not reverse price levels that have already reset higher. Most importantly, they do not instantly repair confidence that has been broken by constraint. This is why recoveries feel uneven. Markets may rebound long before households do. Asset prices can rise while consumption remains weak. Growth resumes statistically, but resilience does not return structurally. The most fragile moment is the one before recognition, when spending still exists, but only because households are stretching. When employment remains positive, but only because firms have not yet adjusted. When markets interpret motion as health. Economic breaks do not begin when something fails. They begin when buffers are exhausted, when there is no slack left to absorb the next shock, whether that shock comes from employment, credit, policy, or geopolitics. This is not about predicting a date. It is about understanding the mechanism, because systems built on leverage, thin margins, and compressed resilience rarely collapse loudly at first. They tighten, they strain, they lock. And when the system finally turns on itself, the outcome is not driven by fear or sentiment, but by structure. If this analysis helped you understand what's happening beneath the surface, not through headlines but through structure, then stay with U.S. Economic Lens. This channel focuses on how the U.S. economy actually functions when pressure builds, how households adjust, how credit tightens, and how small stresses turn into system-level shifts. In the next video, we'll look more closely at why rising household debt doesn't just signal strain, it changes behavior, and how that shift quietly alters the entire economic cycle. If you value long-form, data-driven analysis like this, consider subscribing. It supports this work and helps keep serious economic discussion visible. Thank you for watching. I'll see you in the next episode of U.S. Economic Lens.